Hello, I'm James Yardley, and today I'm joined by Stuart Rhodes, manager of the M&G Global Dividend Fund. Stuart, thank you very much for joining us today.
Not at all, thank you.
Stuart, maybe if we start with a bit of a recap of last year. Your fund was one of the very few which managed to generate a positive return in a very difficult year. So how did you manage it?
2022 was, I guess, a very different year from what we've been used to for the preceding years prior to that. And it was a year where we were really well positioned for that kind of environment. We've got three main sources of dividend investing within the fund: sort of the quality defensive portion, the cyclical asset portion, and then the growth portion. And the growth portion of the fund is always the smallest. It's somewhere between 10 and 20% of the fund. And so the other two portions, the quality defensive and the cyclical assets, really kind of do dominate performance. And 2022 was a year that very much favoured those two parts of the market rather than the growth element. And if we think about how the year developed, the quality defensive kind of part of the portfolio, so I'm referring to sort of consumer staples names here, like sort of PepsiCo, Colgate, Coca-Cola, these kind of names, and healthcare names, Bristol Myers Squibb, et cetera. These businesses really did perform well throughout the whole year. 2022 was defined by kind of an initial growth to value rotation, followed by a pretty strong recessionary narrative given by how far interest rates were moving up to combat inflation. So, as we moved through that as a narrative through the year, kind of defensive businesses just performed well really all through the year. And so that part of the portfolio kind of built consistently and was a strong contributor to performance. And then the cyclical assets also had a very strong year, but it wasn't quite the sort of straight journey that the quality defensive businesses were. So in the first half of the year, you had commodity prices do very, very well. So quite a few of our more commodity exposed cyclical businesses had an exceptionally strong first half of the year, gave a little bit back actually as we moved into sort of Q3, and that recessionary narrative really sort of took over, but then finished the year very strong when it looked like some of the inflation data was starting to improve towards the back end of the year. So I would say those are the two major contributors to why the fund had a good year, is that we had a significant proportion of the fund in kind of defensive companies, and also the other significant portion of the fund is in the more cyclical side of the market, and hence the valuations that we were paying going into 2022 seemed very, very fair, and we weren't caught in some of these high valuation companies that derated pretty significantly. So I think that's how I would kind of describe 2022 too.
And do you think there's now a renewed focus on dividend investing again? I mean, because everyone sort of forgot about it when all these high-flying tech stocks were shooting the lights out, and you had your, more boring, steady dividend payers were kind of thrown out. But it seems like they're a bit more back in favour now. Do you think that's a trend we're going to see continuing going forward as well?
Yeah, yes, I do. I mean, it's no secret that the dividend investing was quite hard work sort of prior to 2022, because the capital performance of parts of the market had been so strong. So if you think about how well growth had done up until 2022, just the sheer capital performance, made up for not really getting any dividends from that part of the market. And, I think what we've learned over the last sort of 15 months or so, that dividend investing hasn't gone away. It was sort of out of favor for a little bit, but people are starting to understand why it kind of has the track record it does over the long run, and why it's such an important part of total returns within equities. And so, given the sheer scale of change that we've seen since the start of 2022, money not being free anymore, yields and interest rates, really, really on a different path than what we've been used to, having a compelling dividend profile, I think, is going to be a much more important feature of any equity really going forward, certainly relative to the 10 years that we had post the global financial crisis. So, for me, the two big aspects of why dividend investing is probably going to be a bit more popular over the next few years, as it has compared to what it has been over the past few years, is that valuation of dividend investing is normally pretty grounded. So you're very rarely paying astronomical prices. So you don't have that vulnerability to high-rated businesses derating significantly, and that can be very painful if that happens. And then also, you are providing some sort of inflation hedge. So if you think about inflation nowadays being much more of a hurdle rate to get over, a much more significant topic than what we've been used to, having a dividend that can at least compete with the inflation rate and critically grow quicker than the rate of inflation, I think is going to be an incredibly useful asset to deal with the next few years, as it looks like the underlying pressure for inflation is now up rather than the downward pressure that we've been used to for the last 10 years. So yeah, in a nutshell, I think, and we've seen a lot more interest kind of in the strategy, and dividends in general, I think have moved up the priority list as a result of what we've seen over the last 15 months or so.
And what is your outlook in the fund for dividends in 2023? I mean, can we expect to see growth in dividends going forward? I mean, obviously your fund, one of the big features of it is it has got a very strong track record of growing the dividend over time. Can we expect that going forward? And do you have any views on a global slowdown and a potential recession? Would that likely to impact the fund at all, or do you not really worry? You worry less, I think, about the macro factors, don't you?
Well, I mean, sort of everyone in my kind of positions, we always have to be aware of the macro factors because they're obviously incredibly important. But the premise of what we do is to try and find companies that we believe that can grow their dividend in both good times and in bad times. So it's critical that we get robust businesses that are generating cash flow, because life won't always be good. There's always something lurking around the corner that will provide a challenge. And what we don't want to do is give our clients access to businesses that aren't capable of paying their dividend at the first sign of difficulty. So, I mean, in reference to your question sort of directly, it does look as though things are slowing down a little bit. And, the next couple of years could be, potentially quite hard work for certain parts of the market. And we want to make sure that we've got business models that are robust enough to deliver our dividend profile through that. The fund has been going since 2008. We've had two very significant sort of dividend tests. The global financial crisis straight out the gate, and then obviously in 2020 were very difficult dividend markets. The two worst since the Second World War. So, we've got quite a lot of experience now of dealing with dividend profiles through more difficult phases. And I do expect the next sort of 12, 15 months to propose some challenges, but I do think, we've got an underlying portfolio that will continue the track record of just delivering dividend growth. The key aspect to that question, I think, is specifically around balance sheets. So we do need strong balance sheets. If I think about why dividend cuts normally occur, it's because balance sheets can sometimes get stretched, and that is almost all of the dividend cuts come from. So we need to make sure that the balance sheet profile of the fund is strong, and that will put us in really good stead to survive any difficult period.
And looking at the fund, it's very different to the benchmark. So how do you go about finding your ideas, Stuart? And can you give us some examples?
Sure. So, what we do is we, construct a portfolio from our investable universe of names where, we've done a lot of work in the 15 years we've been running the fund on identifying companies that we think can grow the dividend through thick and thin, really. So companies that do have the ability to grow the dividend profile even in more difficult markets. And to put some context around that, when we launched back in 2008, that investable universe was about 180 names. Today, it currently sits about 240. So, there is gradual growth to the list that we choose from. And really, identifying those names is quite simple. It's looking at companies that have demonstrated a track record of growing the dividend in recent years. and showing there is, you know, a willingness and capability to grow that dividend in more difficult times as well as easier times when the macro is growing. And so that's, you know, that's what we do kind of all day, every day is test that universe, either by trying to see if there are any names that are on that list that really shouldn't be, or if there are new names that we've identified that should be candidates to be put onto that list. And really, it's a pretty broad list across geographies and sectors. Yes, there are some sectors that are easier than others, and, you know, consumer staples and healthcare, for example, there are lots and lots of candidates that qualify for our list. The US is a great region to find your dividend ideas, but there are some other parts of the world, Canada, Australia, Western Europe, et cetera, that really do have some excellent dividend track records too. So, you know, that's kind of, you know, where we really start from. We don't start from the index. And directly answering your question, you know, because we don't start with the index, we're much more interested in finding companies from the bottom up that we feel will give our end client that essentially that growing dividend into perpetuity. So there will be some big names in there. For example, you know, we own Microsoft. Broadcom is one of our largest holdings. That's a very significant technology semiconductor company in the US. So, you know, we do have these investments that are well known, you know, famous household names, et cetera. But then we will also, you know, have names that perhaps, you know, aren't that familiar. So I'm thinking about, I guess, you know, Amcor is one of our largest holdings and has been for some time. That's an Australian packaging business that has an exemplary dividend track record. You know, it's grown every year for many years now. Pretty defensive kind of business. So that would be, you know, sort of $15 to $20 billion market cap company that not many people have heard of, or certainly when I talk about it, it's not one that you know, people have a view on. So that would be, you know, a classic example of a company that fits exactly what we're looking at. Maybe isn't that well known. I'm thinking of another company called Keyera, which is in Canada. It's an kind of oil and gas infrastructure business, so owns storage taverns, pipelines, you know, critical pieces of infrastructure that allow you know, energy to be, you know, brought out of the ground and delivered to the end consumer. And these are businesses with fantastic dividend track records, very solid cash flows based on you know contracts that are honoured again in more difficult times. So these are the kind of businesses that we're interested in, and we're happy to invest in them if they're famous big mega cap names, or actually down the market cap spectrum at 10, 20, $30 billion, as long as they deliver the dividends that we want. Then if they're attractively valued, then they'll find a way onto the fund.
That's really interesting, Stuart. Well done in 2022, and hopefully the fund can continue to do well going forward. Thanks very much for joining us today.
Not at all. Thank you for having me.
And if you'd like to learn more about the M&G Global Dividend Fund, please visit chelseafs.co.uk.